Hello and welcome back to our second lecture video dealing with CVP analysis. And in this video, hopefully, you should be able to prepare and interpret a cost volume profit graph as well as a profit graph. So in this example, we're going to look at two graphs, and we're going to take those CVP equations that we looked at in our previous video, and we're going to look at them in graph representation. So this may possibly be preferable to you if you're really uncomfortable dealing with algebraic equations. If you are, let me know. We'll work together. We'll work together and make sure you get comfortable with those algebraic equations. The graphs are nice because they give us a visual representation of what the CVP analysis looks like. So what we have here is kind of a chart that picks 4 points of sales or of sales volume. Okay, so the relationship among the volume, the revenue, the cost, the profit, and the volume, we're going to see how it can be expressed graphically, and we're going to see how to prepare a CVP graph. So in order to really illustrate this, we're going to use the contribution formatted income statement for RBC at 4 volume levels: 0, 200 units sold, 400 units sold, as well as 600 units sold. So the CVP graph that we have here, unit volume is always going to be represented on that horizontal or that x-axis, and dollars are going to be represented on the vertical or the y-axis. So a CVP graph can actually be prepared in 3 easy steps. So let's look at those steps. Well, the first thing we need to do, or the first step, is to draw a line to the volume axis that represents total fixed expenses. So if you remember from our previous video, we said that, hey, our fixed expenses were $80,000. So the first step is saying, okay, let's figure out what our fixed expenses are, and we're going to draw a parallel line to the volume axis to show that this is our total fixed expense line. The second step is we're going to choose some volume. Okay, in this example, we're going to choose 400 units. And we're going to plot the representing total expenses. And remember, when we say total expenses, we're talking about the fixed and the variable expenses at that sales volume. And what we're going to do is we're going to draw a line through all those data points back to where fixed expense line intersects with the dollar line. So the blue line that we have here, that's our fixed expenses, that's our total expenses. So what we did was we said, okay, we have our fixed, and now we're going to plot our total. So we're going to include fixed and variable. So the total expenses at 100 units is $110,000. At 200 units, we see that the total expenses for a volume of 200 units sold is going to be $140,000. And we keep on going and going and going. So we see that if we get to the 400 units, we see that our total cost, which is fixed and variable, equals $200,000. So now we get to our third step, right? In the third step, what we need to do is choose some sales volume. In this case, we chose 400 units. And we're going to plot the point that represents the total sales dollars at the chosen activity levels. So we're going to say, okay, at $400, we have sales of $200,000. At a sales volume of 300 units, we have sales revenue of $150,000. What about 200 units? Well, at 200 units, our sales volume is $100,000. Again, all we did was take the sales volume, 200 units, times the selling price per unit, which is $500 per bike. And we do that for 50,000 units, and we also do that for 0. So we see that if we sell 0 bikes, we're not covering our fixed expenses. Actually, if we sell anything from 0 to, what is that? Maybe let's see, if we sell, what is that? Maybe 180 bikes, I'm assuming. It looks like, again, I'm just going off visual here. Our sales really aren't going to cover our fixed expenses, right? But remember, we're worried about total cost, so we need to look at that blue line. Okay, so we have our CVP graph, and we can interpret it, right? We can look at it. We can see we have our fixed expenses, our total expenses, and our sales volume. So the break-even point is where total revenue and total expense lines intersect. So we see that our green line, our total sales, intersects our blue total cost line at 400 units. Okay? And if we scroll over to the left here, we see that that's a sales volume in dollars of $200,000. Now, the profit or loss at any given sales level is measured by the vertical distance between total revenue and total expenses. What in the world does that mean? Well, we compare our two lines, our total expense line and our sales line. Notice down here we have a loss area, right? So from 0 up to 400 units, we have a loss area. Why do we have a loss? Well, because the blue line, our total expenses, is above our total sales line. Once we hit 400 units, that's our break-even point, we see that our sales line, or our sales revenue line, is above the total cost line. So that's where our profit area is. Now, we can also take a simpler approach to the CVP graph, and we can look at what we call a profit graph. Now, the profit graph is going to be based on the equation that we have here, right? Profit equals unit CM times quantity minus fixed costs. And we can see what our profit graph looks like. So in order to plot the graph, what we need to do is we need to compute the profit at two different sales volumes. Okay? We plot those points and we connect them with a straight line. So in this example, we said, okay, let's plot two different sales volumes. In this case, we chose 300 units and 500 units. So we're going to plot the sales volume at those 2 points. The break even here is at our 400 unit level. Notice our profit is 0. Okay, so again, just an even simpler way to look at the CVP graph. Now, we need to really dive into this contribution margin. Okay, so hopefully we're going to go through this Eventually we'll do some examples, but we're going to look at how do we use the CM ratio to compute changes in contribution margin and net operating income. Okay? Again, what drives these changes is going to be the change in the sales volume. Okay? So before we can even dive right into that, we need to look at what is the contribution margin ratio. Well, it's a percentage ratio. Obviously, it's a percentage. Okay? And the CM ratio, or the contribution margin ratio, it's very easy to calculate. All we need to do is divide the total contribution margin by the total sales. That gives us our contribution margin ratio. So let's look at an example here. We have a contribution margin of $80,000. What's our sales level? Well, our sales level has to be $200,000, right? So we take the CM of $80,000 divided by the contribution margin, we get 40%. What does that 40% mean? Well, for RBC with a CM ratio of 40%, that means that each dollar increase in sales results in a total contribution margin increase of 40%. Okay? So we're just taking we're using the CM ratio to say, okay, what percentage of sales, let me rephrase that. Yeah, what percentage will my CM increase if my sales increase by $1? Okay, for every dollar increase, 40 cents of that is going to go to increase the contribution margin. So the CM ratio, again, it's very important. Just like the contribution margin, looking at the contribution margin in ratio form, very helpful for us. So we always want to look at the contribution margin both in total and on a per unit basis. And we want to take it a step further. We will always want to calculate that contribution margin ratio. We can do this in total, or we could do it on a per unit basis. Okay? We could take the unit CM and divide it by the unit selling price. Well, in this case, our unit contribution margin is $200. Our selling price per unit is $500. We divide the unit CM by the unit sales price. We get a contribution margin ratio of 40%. Okay? So it doesn't matter if we calculate the CM ratio in total or on a per unit basis like we have here. Contribution margin is always going to be the same percentage. Okay? Now, we can look at variable expenses in the same way, right? Remember, we're always going to report variable expenses in total and on a per unit basis. Well, we're going to take it a step further. We're going to take the variable expense and we're going to show it as a percentage of sales. Okay, we call this the variable expense ratio. So for RBC, we could see that the variable expense ratio is 60%. How did we get that? We took total variable expenses, divided them by our sales, we get 60%. So we can even go a step further here. And we can say that the contribution margin ratio and the variable expense ratio, those are mathematically related to one another. How? Well, if we take the CM ratio, or the contribution margin ratio, it's always going to be equal to 1 minus the variable expense ratio. So if we can calculate our variable expense ratio, we can calculate our contribution margin ratio by taking 1 minus the variable expense ratio. 1 minus 60% gives us 40%. So let's look at another example here of how important that contribution margin ratio is. If RBC increases sales from 400 bikes to 500 bikes, the increase in the contribution margin is $20,000. How did we figure that out? We can figure that out without doing two separate contribution formatted income statements. How? Well, all we need to do is calculate the contribution margin ratio, right, which is we already have is 40%. We take that and we multiply it by that increase in the sales. So think about it this way. We're selling 100 extra bikes, okay? A unit selling price of $500 times 100 gives us $50,000. That's the increase in the sales. If we take that increase in sales of $50,000 and multiply it by the CM ratio, we can show how much in dollars the contribution margin is going to increase. So let's look at a quick example here, right? Coffee Klatch. It's an espresso stand in downtown office building. They give us the average selling price per cup of coffee. It's $1.49. They give us the average variable expense per cup of coffee, which is 36 cents. They give us the average fixed expense per month as being $1,300. We need to calculate what's the average of 2,100 cups of coffee sold each month. What is the CM ratio for Coffee Klatch? Okay? So we have an average of 2,100 cups of coffee being sold each month. What's our CM ratio? Well, it's very easy. We have our cup, selling price per cup of coffee is $1.49. Do we not? Hopefully you see it right here. So in a calculator, or in your head, whichever you prefer, I'm going to take $1.49 and I'm going to divide that, which is the selling price, I'm going to divide that by the variable expense per cup, which is 0.36 or 36 cents. That gives me a contribution margin of $1.13. I'm going to take that $1.13 and I'm going to divide it by the sales. And hopefully you got answer B. And there it is right there. Figure out the CM ratio, take the unit contribution margin, divide it by the selling price. That's easy to remember. How do we calculate the unit CM? Oh, unit selling price minus variable expenses per unit. So what we have here is gives us a relationship between profit and the CM ratio. So just like we expressed the relationship between profit and the contribution margin, we can do the same thing with contribution margin ratio. There is a relationship between profit and the CM ratio. And guess what? We can express this, just like we see on the slide, in terms of an equation. So let's look at an example. We know that the CM ratio for RBC is 40%. Okay? We can calculate what their profit would be selling 500 bikes, right? We know that if we sell 500 bikes, our sales volume is going to be $250,000. We're going to multiply that by the CM ratio. We get $100,000, which incidentally is the contribution margin in dollars. We subtract out our fixed expenses, we got profit of $20,000. Okay? This next part, it's a little bit more in depth, so we're going to save that for another video. We're going to show how net operating income changes if we have a change in variable cost, if we have a change in fixed cost, if we have a change in selling price, and if we have a change in volume. Okay? But before we get to that point, again, I just want to quickly recap what we talked about. We saw how to put together a CVP graph, right? We know there's 3 steps. We know that before we even start to implement these 3 steps, we know that, hey, the vertical axis or the y-axis is going to be dollars, horizontal or the x-axis is going to be our units. First thing we do is draw a parallel line to the volume axis, and this helps us visually see what our fixed expenses are. Remember, fixed expenses in total never change. So we could see that if we sell 0 or 600 bikes, our fixed expenses are always going to be $80,000. Okay? We can assume that 0 to 600 bikes is our relevant range. Next thing we do is we figure out, okay, what's our total cost, right? So what we need to do is we need to choose some sales volume. We're going to pick 400 units, and we're going to plot all the points that represent total expenses. Total expenses means I need fixed and variable, okay? We're going to draw a line through the data points back to where our fixed expenses intersect with the dollar axis. Next thing we do, we pick a couple sales points and we plot them, right? The green line is our sales volume. And then we know how to interpret this. Where total sales meet total cost, that's our break-even point. Anything above the break-even point is profit. We can see that because the sales or the total sales exceed the total cost. Anything below the break-even point is obviously a loss. We can see that visually because the total cost line is above our sales volume line. Okay? We looked at a profit graph. We looked at the CM ratio, and we saw that the CM ratio can do the same exact thing that the contribution margin can do. We saw how to calculate the CM ratio. CM divided by sales. We saw that we can do this in total, or we can do it on a per unit basis. We still get the same CM ratio regardless if we do it in total or on a per unit basis. What that means is if we have totals, we don't need to break it down per unit to figure out what the CM ratio is. We can use those totals. Or vice versa, right? If we have per unit, we don't need to calculate total sales, total fixed or total variable expenses, and divide those. We can do it on a per unit basis as well. We said variable expense ratio, just a percentage of sales, or looking at variable expenses as a percentage to sales. We saw the ratio, how we calculated variable expenses divided by sales. And we said, hey, there's a relationship between the CM ratio and the variable expense ratio. If we know the variable expense ratio, we can calculate the CM ratio. We just need one number, that variable expense ratio. Once we get it, guess what? We automatically know what our CM ratio is by taking 1 minus the variable expense ratio, which gives us our CM ratio. We saw that the CM ratio we can use the CM ratio to calculate the increase in profit that results of an increase in sales volume. So when we come back, we're going to really apply the concept of CVP and see how our bottom line or our net operating income changes if we have changes in variable costs, fixed costs, selling price, and volume. So tune back in for that one.